On February 19th, FinCEN issued a new publication that was signed off on by the federal banking regulators that discussed how the Bank Secrecy Act applies to nonprofits and charities. And the core message from these federal agencies, and they include the OCC, the Federal Reserve, the FDIC, the NCUA, as well as FinCEN, was that they don't view account activity in charities as being inherently suspicious, and they don't view those accounts as being inherently high risk, and particularly high risk for violations of sanctions laws, anti-money laundering laws, or terrorist financing laws. And a lot of people respond to this by saying, well, that's obvious. I mean, when my grandma takes $5 and walks it down to our local food bank and the food bank deposits it in their bank account, that's not terrorist financing. So why is it that FinCEN felt the need to issue this publication? Well, today I'm going to talk a little bit about why this publication was issued and what banks and fintech companies can do now to respond to this publication when dealing with charities and nonprofits. The fact is that a lot of bank accounts that have been opened by nonprofits and charities have been used for criminal activity. And that includes basic fraud. So for example, if my grandma goes down to the food bank, she takes her $10 bill, gives it to them, they say that it's going to be used to feed starving children, but instead they just take it and go to the movies. Well, that's fraud. And you saw a lot of that type of fraud, for example, with hurricane relief charities. And similarly, accounts are often used for money laundering. So if a drug dealer sells crack to someone, takes the $10 bill, goes down and deposits it into an account that's opened by a nonprofit, and that nonprofit wires the money to another nonprofit that's located in Colombia and is opened in the name of an orphanage, but that orphanage is in fact run by a Colombian drug cartel, well, that would be money laundering. And it's also used for sanctions violations. So if you have an account that is opened here, they wire $10 to a South Korean educational charity, but in fact that charity is really controlled and owned by the North Korean government, well, that would likely be a violation of sanctions laws. And the difficulty is that banks and fintech companies have a very hard time when they're just looking at the account activity in determining whether or not it's criminal activity. And that's partially because charities often engage in very unusual forms of transactions, particularly when they are contributing money to organizations located outside the United States. And it's difficult when a bank is just looking at the account activity to determine whether it's lawful or unlawful. So banks will often reach out to the account holder, ask about various transactions, monitor the account carefully, look into news reports that have been published about that charity and about the other charities with which that charity is interacting. But that's all expensive. And so a lot of financial institutions have decided it's just cheaper to close the account than to do all of that monitoring activity. And that's bad. I mean, it's bad for nonprofits, it's bad for charities, and it's bad for society. It's bad for the people that those nonprofits are trying to help. So because of that, FinCEN issued this guidance to try to clarify for financial institutions the circumstances under which it is permissible to do transactions for nonprofits and charities in the United States. So does FinCEN's new publication solve the problem that it's just expensive to monitor transactions in accounts that are opened by charities and nonprofits? No. It's still expensive, and there's still going to be financial institutions that sometimes decide to just shut down an account rather than incur significant expense to monitor activity in that account. But the publication does do a couple things. One thing it gives financial institutions something that they can use to push back when an examiner or someone else at a regulatory agency demands that that institution engage in very expensive forms of due diligence to monitor an account. The second thing it does is it just gives some helpful guidance to financial institutions in identifying specific categories of information that they should request when they're deciding whether or not to open up an account or when they're conducting diligence into specific transactions. So, for example, the geographic area in which the charity operates is critical. If it's just domestic, that's probably lower risk than if it's operating primarily in the Middle East, for example. Similarly, it's important to get information about the donor base. Are the donors individuals on the street that are giving US currency to somebody standing on the corner who's holding a bucket? Is it the donor base people that are making online contributions? Or is the donor base large institutions that are making very large dollar financial contributions? It's important to know that ahead of time so that they can monitor activity in the account and see if it's consistent with that donor base. It's also important to get information about the nature of the beneficiaries. Are they sending the money directly to beneficiaries? Are they sending the money to intermediaries? And who are those beneficiaries? Are they individuals? Are they schools? When you have that type of information, it makes it easier to monitor the account and determine whether or not specific transactions in that account are appropriate and consistent with the purpose for which the account was opened. So, of course, this still leaves a lot of room for discretion, and it can be very difficult for a financial institution to determine whether or not specific types of accounts that they have are high risk or low risk. But good news, I'm a lawyer. So if you do have questions about how FinCEN's new guidance applies to charities or nonprofits, or if you're a charity and nonprofit and you'd like more insight into this new publication, give me a call. I'd be happy to talk to you.